Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about value stocks and fear. A great combo like Maverick and Goose. I can't wait to see that movie, by the way. Now, late last year I did a video on value stocks that I liked at that time, and they were Intel, which is down, Citigroup, which is down, Kinder Morgan, which is up, and Dow Chemical, which is up. That means I'm batting 500. Pretty darn good. I get a big fat contract extension. That's how it works. Now, if you put $100 into each one of these at that time, you would be up 6% from that point. However, if you put it into the S&P, you'd be down 12%. And you'd be going, oh my God, Dave, how did you do it? How did you do this? And I would say, I was inverted.
Bullshit.
That's right. Now, of course, at the same time, you could say, hey, didn't you also talk about Facebook stock at that same time? And I have to say yes. You could say, well, I found your Facebook stock. It was at TJ Maxx back in the corner on the discount aisle marked 50% off. Ha, ha, ha. And I'd have to take it because that's what we do. Now, we pick some winners, we pick some losers. Now, value has definitely been a good spot to put our money in recently. So that's what I was talking about today. So if that is what you're looking for, please stick around. Whoop. So I will link my video above that I did on these 4 stocks last year. It was in December, and these were the value stocks that I liked at that time. Head into 2022, fast forward 6 months, and obviously things have changed drastically. So within this, though, what I find so interesting is this is, 4 different industries, but all within the same, value kind of idea, and you can see the outcomes are quite different. So Citigroup, year-to-date performance down 15%. Intel down 15.75%. Then we swing the other direction. Kinder Morgan, part of that oil and energy segment, up over 25%. Pays a big dividend as well. And Dow Chemical up over 18%. So you can see the drastic difference from one industry to the next and how these things have played out over this first 6-month period. Now, within my own personal portfolio, a lot has changed, especially when it comes to Citigroup. I sold the vast majority of my shares just a few weeks ago, right before Berkshire Hathaway came out and said, hey, guess what we're buying? We bought Citigroup. So not all is lost, because what I did was I sold that, took the tax loss, and I rolled those proceeds over into XLF, which is the financial sector ETF, because I do have a positive feeling about banking going forward. So I'm keeping that money working in the banking sector, just not within Citigroup. Now with Intel, I have all my shares still, and I continue to sell calls rather aggressively, which has paid off pretty well. Been able to average down pretty well on the stock itself, so I don't feel that full 15.75% loss like you might have felt it if you just bought and held the stock. So as far as selling calls, that's worked out pretty well this year. But I still have a positive feeling about Intel going forward, being that semiconductors are in such high demand, although they do a lot of business outside of the US, which is part of their problem right now. But with all their future expansion plans, I still feel favorable about Intel, so I plan on keeping their shares working going forward. Now with Kinder Morgan, I think it's fairly valued. I'm not going to add any more shares, but I like the shares that I do have, and I like that big chunky dividend. I'm just not adding to this position anymore where it's currently valued. Same with Dow Chemical. I like the shares that I own. I'm not going to add to the position anymore. I actually had a few shares get called away because I sold some calls rather aggressively, and I'm okay because I reduced my position a little bit. I think it's fairly valued, so I'm not adding any more to that position either. All great stocks, but not something that I'm going to be piling money into at the moment. Now, I'll also link above a video that I did on VTV. This is a Vanguard Value ETF. It's another great way to play the value segment. But here are the top 10 holdings within VTV. So you're going to get everything from like United Health Group, Johnson & Johnson, Procter & Gamble. You are going to get oil and energy like Exxon and Chevron within here. You're going to get healthcare like Pfizer and AbbVie. You're going to get your Coca-Cola as well. So pretty broadly based. You mix in all these sectors together, and overall this is down just about 2 or 3%. Again, versus the S&P, which is down 12%. It's really outperformed. And within VTV, you're going to find a lot of these stocks have some common attributes, meaning whether it's Chevron, JP Morgan, or Pfizer, you're going to get a chunky dividend. It's going to make you feel good. Like if the stock drops a little bit more and you buy some more shares, you're going to get an even chunkier dividend, which is just fine with me. When you look at price to sales ratios, which are important, right? We're talking about onesie, twosies, maybe a 3. Not those 10, 20, or 30 that we saw late last year, right? With all those tech stocks that people flock to when everyone's winning. They're going to be flocking to these now. Those low price to earnings ratios on these, we're talking about 10 or under, and we'll come back to PE ratios here in a minute. They all have manageable debt as well, and they have cash on hand and strong, consistent sales that lead to profits and profit margins. These are the things that make a value stock a value stock. So we went back about a year ago. It was really in fashion to throw PE ratios out the door. had no meaning, useless metric. But nowadays, that's the hot topic, right? Everybody's talking about multiple compression, the S&P 500, where will we settle out at? And if you go back and tap yourself on the shoulder about 6-7 months ago, you would have said, hey, throw out anything that doesn't have a PE multiple. Throw out anything that has a multiple over 30, and you're going to be so much better off. You'll thank me later. And here's a comparison chart of VTV, the Vanguard Value Index Fund we've been talking about, year-to-date performance compared to a few others. So year-to-date, it's down about 2.8%, pretty much flat on the year. Now, if you compare that to the S&P 500 index, which is the second one down here, we're down about 13.8%. So it's really outperformed because this one has just about everything mixed into it. The top performing sector has been XLE, right? That's the Spider Energy ETF represented here by the blue line. That one's up over 61%. So if you could go back in time and put all your money to work, you'd want to put it in an energy this year. On the opposite end of the spectrum, we've got ARK, way down here, down 54%. So ARKK is the ARK fund. It's been getting beat up all year long. This has all those high-flying tech stocks. They typically don't make a lot of money. If they do make money or they're just starting to turn around, they've got a very high multiple associated with them. So I like to think of myself as a value investor because I think value is always the good play. That's what we're looking for. But what is value is not always clear. Some of the stocks, even in the ARK fund, will become great value plays, just like oil and energy, which is something that nobody really wanted to touch a year ago. I shouldn't say not everybody. Some people found it and they picked it out and they added to that position and it worked out quite well. For several years, oil did nothing. I mean, this is a 10-year chart of XLE, and shares of XLE purchased at the peak in 2014 would still be worth less today. It was over $100 a share. Not a lot of great opportunity here until the start of the pandemic. Peak fear, not just for oil, but for the entire market. But we bottomed again in late October of 2020 before taking off as the economy started to gradually reopen. Now, of course, the war in Ukraine has exacerbated the issue, but that was great value and peak fear. So at this point, maybe you're thinking, this is all great. We know what VTV is, we know you like value, but now what? Well, for 10 years, if we look at this chart, the S&P, we have been in a lovely secular bull market run. Looks like we may be changing course. We've got talks of recession. We got Microsoft coming out saying, hey, we're cutting earnings and revenue guidance. We've got Elon coming out tweeting, right? Now, I don't take a lot until he actually does something, takes action. But we've got him coming out. We got Jamie Dimon from JP Morgan saying it looks bleak outside. And of course, we have the beginning of QT or quantitative tightening. So lots of headwinds, and the only person holding a bag of market caffeine is a psycho named Putin. Now, I certainly don't want to try and time the market, but where is their value and fear? And I don't see enough yet. The fear gauge, the VIX, what we're looking at now, has been a good trading tool of late. Right, this chart shows the VIX versus the S&P, which is overlaid. And peaks over 30 in the VIX have proven to be good times to trade the S&P, while dips down into the 20s, low 20s, let's say, have been a good exit point. But for all we know, we might be range bound in here. We might be stuck in this for a long period of time, and where the S&P just trades sideways, which is great if you do like to sell options and have confidence enough to put money to work. But it still seems that with all these headwinds, we have not rolled over completely. That is, the market needs more fear. At that point, where investors feel that they have to succumb and give up and start selling to avoid more losses, that feeling, that is the pain point. That is when we should see the actual value stocks start to emerge. And that is why I'm keeping a larger cash position than I normally do on the sidelines. Not so much for fear of missing out on an uptrend that may last 1 to 2 weeks like what we've just seen recently, but for my desire to have more available as we tick lower. Also, one other interesting resource, if you feel nervy about this whole situation with all these negative influences that we're talking about, you can also keep an eye on the Fear and Greed Index from CNN. So it's just a simple way to gauge whether stocks are fairly priced. It uses 7 different indicators to just measure the market mood, right? So if you're real emotional about the stock market, might be a good point to reference this. So take your time, look it up, and read through the info. But what it boils down to is a low number represents excessive fear, while a high number represents greed. The whole idea here is to help investors navigate their own emotions and biases that might influence your decision making. So if you're feeling spooked, for example, check out the Fear and Greed Index and understand what these periods of market fear are actually what generates opportunity. Because it's our job, right, as investors, to use fear and value to find great opportunities. So the whole idea, be greedy when others are fearful, but also be patient. So it reminds me, it's not always time to act. Great quote from Warren Buffett, right? The stock market is a device for transferring money from the impatient to the patient. I like that one. So as far as my personal investing, I will continue to buy a little bit here and there, averaging into the market, not trying to time it, but just kind of buying into the market over time. I'm going to be shopping for great value and fear. When I can find those two together, that's when I really want to pounce and actually deploy more capital into the stock market. Right now, it feels like we're going from this secular bull market to something new. I don't want to call it a secular bear market yet, but we'll see where we end up in the next 6 months. Again, not going to be too aggressive with my investing. Now, if you have any questions on any of this, please ask down below. I really appreciate you watching. Please like and subscribe. We'll see you next time. Take care. Whoop.